I'm Maloni Bhatt. From sticky inflation, where we saw very high food prices across the world, to the continuing geopolitical tension that has triggered a surge in petroleum prices and a volley of rate hikes by central banks across the world, 2022 was a roller coaster year. Now, if you look at markets and investments, especially India, the IPO market was down. Returns on equity mutual funds were muted compared to 2020 and 2021, but the number of demat accounts increased, indicating an appetite for equity investments. Now, with high interest rates, fixed income investments have become attractive. But what's the outlook on asset classes, and what's the best way to allocate assets for 2023? I have with me Chirag Mehta, CIO, Quantum AMC. Chirag, welcome.
Thank you, Maloni. Thank you for having me.
And Feroz Aziz, he is the Deputy CEO of Anand Rathi Wealth Limited. Feroz, welcome.
Hello.
All right. And both these gentlemen are going to give us their thoughts on asset classes and the best way for us to allocate assets. Feroz, I'd like to begin with you. You know, many economies are expected to be very badly hit in 2023. India still remains vulnerable, but perhaps could be among the more resilient ones, many people say. In this backdrop, you know, what's the sort of severity you see on the Indian economy, which could have an impact on markets and subsequently investments?
Yes, Maloni, if you ask me from a world standpoint, this is one of the few times, or it's never happened in my career, that when the globe is actually in trouble, India is not categorized as one of the weaker links. Like in 2013, when the balance sheet size of the US Fed was being reduced, we were called one of the fragile 5 countries. This is the first time we are standing strong. So what's happening is the economy is doing relatively better from a globe standpoint, almost 300, 400 basis points better this year. Followed by UK, which is at 3.6, US at 1.6. And of course, there's a large probability of US slipping into recession. I was speaking about 5-7 US fund managers on my visit last month. And 70% is the odds, which is what those fund managers predicted for a US slipping into a recession. That's point one. Point two, I think India, since it is in the brighter spot, is also getting a large capital inflow. Unlike in most other situations where there's flight of capital from the perceived riskier markets to the safer havens. So I personally think this time your capital flows will not be as bad in spite of there being a risk aversion. That's point two. Point three, I think we have clocked in about 9.7% for the first half year from a GDP standpoint. We predicted to close at about 7% this year, 7.2 on a long-term average of 5.8. So we are going to be greater than our long-term last 10-year average of the GDP. Our government's fiscal prudence is reasonable because of the high GST and direct and indirect tax collection, GST collection being 27% higher. We predict that the government will be left with 3 lakh crores more of revenue than what they predicted during this budget of 22.16 lakh crore. Given all that, we are reasonably bullish that markets will be resilient and the outperformance of India vis-a-vis the rest of the globe should continue, but not in that quantums like it did in calendar year 22.
All right, yeah. So muted from 22 and 2021, but relatively better off than most other countries across the world. That seems to be, I think, the view across the board. Chirag, what about you? Give us a roundup of 2022 from your vantage, and what are the from your point of view, what are the 3 or 4 broad trends and themes that you forecast for 2023?
Sure. It was a really uncertain environment that we came in 2022. We started with, already we were sitting in a gush of liquidity, which kind of quickly changed because of inflation coming in and central banks trying to fight it. So scenario economic backdrop completely changed from a loose monetary policy with a lot of liquidity to a one which was a tighter monetary policy and restrictive liquidity. So overall, given that change in backdrop, what we saw was, so if you held a portfolio of say just of equity and debt, it didn't work well because the drivers for both were same and both were coming down together. And if you had an allocation to something like gold, which was doing really well at that point in time. So overall, again, asset allocation strategies did really well than a single allocation strategies. That's what we saw in 2022. And it was a good reminder that you need to asset allocate and build your portfolio rather than just looking at what's resilient in terms of as compared to the global world. So even today, India looks more resilient as compared to the global world, like Feroz said, and completely agree with his points. Given the strong capex cycle we may see in Indian markets, which is very, very contradictory to the offshore markets. Equity allocation will always help. What we saw last year or last few years, given the shocks that of demonetization, GST and COVID, larger companies became larger. Even last year, we saw that the bluest of blue chips did better than the broader market. Again, that was a theme which has been there over the last few years, and we think that it will continue because of these shocks that we saw, and that is going to translate to bigger companies. We have seen that in numbers, right? Revenues of larger companies are getting better. The fixed capital formation for larger companies is better than the smaller companies. So that trend isn't going anywhere. So we think that if you are a larger allocation to equities and equities, you need to be sticking to more large caps, given that theme that we are seeing unfolding. Second theme that we look from a market perspective is value coming back strongly, which was not the case from 2017 to 2020, where, because of liquidity, growth was doing well. Growth and quality were the drivers of returns in equity markets, which may not be the case going forward, like what we saw in 2022. Value made a comeback, and I think that may last until we see this restrictive monetary policies in place by central banks continuing. We may see that value style as a style would outperform growth. Again, Indian equities will sustain the outperformance that we saw. Quality, not only quality, but sustainable investing, which also took a backseat along with quality in 2022, could also make a comeback. And from a sector perspective, we think that financials, autos, and IT is currently not being, is kind of out of favor. It's similar phase that we saw them in 2017, where everyone was talking about demand destruction because of the global world. Similar to the trend that we're seeing today, but we think that these three sectors, financials, autos, particularly two-wheelers, and IT should outperform. And amongst all these trends, I think investors adopting a more asset allocation approach rather than a single class asset chasing behavior will not work well. So I think these are trends that we see unfold for next year.
All right, these are good points for investors to keep in mind. Feroz, I wanted to touch upon interest rates. High interest rates generally don't sit well, with consumers, home loan buyers, even markets. How do you see interest rates moving and impacting consumption and markets especially?
Miloni, to my mind, interest rates have a large implication to all assets because that's the thread which ties them all together. But if you look at how India, relative to its average interest rate has been, the 10-year GSEC being at 7.2, 7.3 is marginally greater than the average of the 10-year GSEC for the last 10 years. So it's not something very outrageous for a country like ours to see interest rates where they are. Point one. Like for a US, they've seen inflations and interest rates which they've not seen, several of them in their own investing lives. And that's a very, very abnormal situation for most countries. For us, we still marginally at a stone throw distance from the average interest rates we have seen. That's point one. Point two, I don't think the interest borrowing rate for most individuals is so high. Today, a home loan rate at 8.25% is just 0.5% to 1%, 0.75% greater than what a government of India borrows. So I think if Feroz can borrow at 8%, a home loan, where government of India is themselves borrowing at 7.2, 7.3, that's the least spread possible. What has happened over the last 1 year is the interest rate was a upward yield curve, which was like how? The short end of the yield curve after COVID had been suppressed dramatically to infuse liquidity. Now that has got corrected. The 10-year GSEC has not moved up too much. So the great news for every investor and a citizen is the fact that your borrowing cost has not gone up substantively. And the second is your debt funds, which are more related to not the repo rate, but you making money or losing money is going to be dependent on different larger periods. Those have not got as adversely impacted as much as the repo rate increase has been. That's point two. Point three, I think debt is a huge opportunity from an investment standpoint as well in India, because today a person is able to make 6.5% after tax by lending to government of India. So why would I apply any mind? So all my money, debt money, is in just one or two funds, which only lends to central government, has a possibility of making between 6.3 to 6.5% post-tax locked in, which is implied to be a 10% fixed deposit. If I bought 11% fixed deposit and pay 43% tax, is when I make 6.5% return. So if I'm able to make 11% implied FD in my name, now that's a huge debt opportunity, which brings in certain degree of shock absorbance to the overall portfolio, giving me the risk appetite to use their equity side.
All right. Okay. All right, Feroz. We'll come back to some of these points a little later, but Chirag, to you, yes, there is market volatility, there is global uncertainty. How do you see, Feroz has laid out a picture where things look okay. You're saying also that India is perhaps going to be resilient, and you've also provided segments or sectors which you think may perform well. But how do you see investors responding, and what are the sort of investment strategies that you would recommend from your vantage?
Sure. So yes, there is consensus that growth will be better. We are more stable than the global world, but India is not decoupled per se. There could be risk emanating from the global world that could impact. If you see last year, FIIs were big sellers. It was only because of the resilience of domestic investors that we stood the ground so well. Because FIIs were relentless sellers for much of last year, and they ended also with a very high number of negative flows into 2022. So it could be anything. It could be, of course, every nook and corner or any place in the globe. Interest rates are getting attractive for anyone to lock in at the high end of the curve. So that could be one play where capital may chase that at that point in time, and therefore flows can get lesser into equity markets. Or it could be just because if you look at India on an emerging market map, it's still looking expensive. It's not that we have become expensive. It's because others have become cheap. The likes of China and other markets have become extremely cheap. So there could be capital which kind of questions, should I be buying those markets, or should I be buying this growth and stability, although at a higher valuation in India? So those could be issues that India could face. And therefore, in such a kind of market scenario where global is really slowing down dramatically, India will also slow down from the growth that we saw in 2022. There could be uncertainties and shocks along the way. And therefore, in such kind of scenario, although your bulk of your allocation should be equities, given the stability and growth it offers, it should be a good asset allocation mix that you need to play out. As debt also offers, if you're having a 3-year plus kind of horizon, like Feroz gave example that it's giving a good yield to lock in at these levels, you could have some allocation if you understand that market well. And of course, a kind of gold allocation. If really things really slip out of hand in the global world, gold is one thing that could help your portfolio. So overall, we have been advocating a 12-80-20 strategy where you have some emergency corpus, a big allocation of core equity of 80% and 20% to gold. I think that strategy looks apt for markets that we enter into 2023, given the mix of visibility and the unknowns that we kind of could face into next year. So overall, that 12-20-80 strategy looks really apt going into the next year, which kind of will help you to make good returns as well as balance the risk and keep your portfolio under check if something were to go wrong.
All right, Feroz, what's your view on the 12-80-20?
See, I think if you look at from an asset allocation standpoint, if that's your question, Miloni.
Yes.
Yes. So if you look at asset allocation, I personally think there are 2-3 decisions one needs to take. To my mind, all assets are relevant to everyone at a point in time. Firstly, before I get into what allocation I would suggest, after having met a few thousand HNIs and some retail through media, I get a sense that most of us have a habit of falling in love with one asset. And if somebody is real estate heavy, he's going to be real estate heavy all his life. So people fall in love with assets instead of falling in love with their objectives. I think that's one submission I would do to every viewer. Introspect whether you are subconsciously falling in love with assets. the means are not important. Ends are important. Ends is nothing but your objective. That's point one. Now let me come to what asset allocation I would recommend. I think this is the year where most assets are at the cusp of a reasonable return, and none of them are at extremes. If you look at equity, I personally think equity from a long-term standpoint, 3 to 5 years, is going to get a median return, which is Nifty's median return is 11. So if you ask me what is the odds that Nifty will deliver median plus returns over 3 to 5 year periods, the answer is a good 80-90% chance. Now, if you take active management like Chirag, they've done great value creation in terms of alpha generated. 2 to 3% alpha from a team like his is not outrageous as an expectation, especially if you gave a team like that time. So if you're able to make 13 to 14% in equity, as long as you don't meddle with equity, it delivers you that 13-14%. When you get tempted to do something driven by your emotion is when you destroy the value which was supposed to be created. That's point one. On the debt side, I would say I would put in 20% in debt, 60-70% in equity, just about 10% for global objectives to gold. And that too, from a vehicle standpoint, I will only say sovereign gold bond. On the debt side, I would say keeping life simple is very critical. So the vehicle also, I'll take another step, Miloni. It has to be a target maturity fund, and equities, I only participate through a mutual fund, not directly in PMS. And leaving real estate out because most people are heavy in real estate. 67% was the average allocation of a new client we onboarded over the last 1 year. If we onboarded 2,000 families, we realized that the amount of real estate is already 67%. So I would not advocate any real estate given the love we have had for real estate over the decades.
All right, Feroz, that was quite detailed. Thank you very much. Chirag, looking at mutual funds specifically, for our viewers, if you could explain equity fund versus a debt fund versus a multi-asset fund, and the relative advantages and disadvantages, especially as we go into 2023, and your recommendations.
Sure. So equity funds are funds that invest in stocks or of companies. They buy equities. They kind of, if your horizon is really long term, then probably equity funds are where you could have a big chunk of your allocation. Equities or long run have compounded wealth by 14-15% over the long run, and we don't see that changing. There is a simple equation. India has grown at 6.1% real GDP growth since last 40 years. We don't see that changing. We think India can still grow at real GDP growth of 6.5% and a nominal an inflation of around 5.5%, which nominally is 11-12%. Given that equation, India could still generate about 14-15% in active management over the long run. So equity as an asset class, you need to understand it's volatile, it's a little riskier, you need to have a longer time horizon, and I think it's a fabulous way to create long-term wealth. Coming to debt markets, it buys the papers of issued by government. So it's government securities that they invest into. Plus there are credit funds which kind of lend to companies as well. So there is a whole gamut of products. Even in equity, there is a whole gamut of market capitalization that you can play, from large cap to mid cap, small cap, and thematics, which are, as you go deeper on the curve, it's kind of riskier. So one should build a pyramid where large cap, value, etc. should be the core. And then as you go up the ladder, it should be smaller allocations because it becomes riskier as you go at the top. Similarly for debt, government securities are safer from there's no credit risk per se, but as you go into other credit plans, etc., it gets more riskier. So we think that investors, if they don't understand those things, should avoid them as an investment. Debt could be short to medium term kind of horizon also that you could look at parking your surplus, especially things like liquid fund, etc., could be used for emergency corpus, etc. And multi-asset funds are funds that kind of dynamically allocate to equity, debt, and some to gold as well. So they are either a 2-asset class or a 3-asset class, which dynamically allocate across asset classes. So if you think that you don't understand markets well, and if you want to leave it to an expert, a professional, to manage how much into equity, how much into debt, how much into gold, then these are ready-made solutions that you get from mutual funds. But one should understand whether those asset allocation mix are appropriate for them or not. If not, then they should craft their own asset allocation strategy by a financial advisor or someone like Feroz who can help them. But overall, one should understand each instrument they are investing into and accordingly say that whether it's right for me or not. So I think so it's a ready-made solution versus a DIY, do it yourself, that one has to decide at the end of the day and then fill it up with the right mix of assets within it.
Yeah, we also want to clarify that, we're not here to give advice, just pointers, and all decisions have to be taken by themselves after consulting the right people and experts. Feroz, moving on from this, for Indians especially, the US markets are the favorite destination, especially when it comes to diversification, international diversification. With the way the US markets are expected to perform and the way the economy is expected to perform, the US economy that is, what would be your advice to Indian investors in this period of turbulence?
Yes, Miloni, I personally think that you should always consider an investment after performance has been bad. Unfortunately, most of us love the rear view mirror analysis. So last September 2021, we released a note which said you should not touch US equities through a barrage poll. Now, having seen the kind of underperformance the larger indices like S&P and the industrial average, Dow Jones Industrial Average have had, I personally think US is still a destination today far better than a year back when people were it was a screaming buy from an inflow standpoint. So point one I'm making is, if you have global objectives, if you want to have a foreign holiday, if you want to send your child abroad to study, these are great times to collect US equities. Especially given the fact that the dollar appreciation, which is further possible because we are now at 82 from a rupee dollar conversion standpoint. So US equities is a little more attractive. If you have invested in anything to do with a thematic investment, which is where most people put thousands of crores, which was a NASDAQ fund, which I think is a very counterintuitive strategy. Firstly, you go outside the country for diversification and reduction in risk, and you step out of the country and buy the highest risk item, which is the highest standard deviations or volatilities, which is a NASDAQ ETF, which is not a great strategy. So revisit your global portfolio. Don't have thematic schemes. Your purpose of going outside is not return spinning. India is one of the best countries from a return standpoint. You're going out to mitigate risks. So if you're going out and then again doubling up the risk, then it was a counterintuitive action. So that's my pointed recommendation on the global side. But most of the damage is done. If the damage is done, don't panic now. You may be exiting it at the trough by looking at the past performance. If you've entered it at the wrong time, at least don't make two wrongs and try and make a right by exiting at the trough.
All right. Okay. This is my last question, in fact, to both you, Feroz and Chirag. India, as we've been speaking, and turns out to be perhaps more resilient over the next 1 or 2 years than most other economies. It's overtaken the UK to become the 5th largest economy. And there are reports which are projecting that it could be the 3rd largest in the next decade, especially if the way our policy is going, and if the growth continues to stay on track, our incomes are expected to rise. I'm focusing now on Bharat driving demand and consumption. From your vantage, how do you see the growth of the Bharat investor in 2023 and beyond? Do you see this at all? Feroz, if you could start.
Yes. So firstly, there's several points you made, Miloni, very interesting ones. So point one, the last part of the question, which is Bharat. I think India is now saving. I think last 1 year, retail India has been far smarter than HNI India and also FIIs. Because they are far more disciplined, lesser informed, so they're not being more skeptical than they should be. So that's why you see 10 years back when the SIP number per month was about 600 crores, today you see 13,600 crores. That's a great increase. Of course, that's a very long period. Even if you see April this financial year, you were looking at 11,900 increasing to 13,600, and it's been an eventful year with so much of gloomy picture painted across, especially from the geopolitical side and the inflation side. So point two, I think India has started investing into capital markets, and I think that will only grow. Our projections are this number of SIP per month would reach 25,000 crores. It's almost a writing in the wall in the next 3 to 4 years. At worst, you will be at 25,000 crores because people are coming on the back of education, which was started in 2013, which is the investor education program. They're not coming on the back of greed, which is what used to happen with Indian retail. That's a clear different trend. Then coming to my mind, the biggest opportunity in India is, one is, of course, nominally you will grow at 12%. Finding businesses in a capital market which has the highest listed stocks in the world. India has the highest listed stocks. Finding businesses in the listed space which can grow at 20-25% is not very difficult for a Chirag who has the acumen to pick up and teams of those kinds. So getting that extra 3-4%, which the US market can't because it's a 60-year older market than India, is one very important additional risk cushion and a return spinner you can make being in India. I think that 3% extra, 2%, 3%, like for Anand Rathi's selection methodology has generated 3.17% extra since inception, which is 9.5 years. So that automatically gives you equal to your capital in a 10-year investing time frame. Instead of 12 of Nifty, if you're able to grow your money at 15, you get on a 1 crore capital, you get 1 crore extra just by the alpha, which US is going to find very difficult to generate. So Bharat is participating, and one unique opportunity for India is not just the GDP growth, but also a superimposition of extra value you can create in the largest listed space of the world, which is Indian capital markets.
Right. So tremendous opportunity, and it's a great time for everyone. Chirag, you have the last word.
Sure. So India will keep growing. We are at $2,000 GDP mark at the cusp, and it kind of accelerates from here. So with that 6.5% real GDP growth, I think there will be many more people coming in the middle income bracket, as we call it, as the middle class, which is expanding. So if you look at 14% of India was in middle class bracket in 2004-5, today we are at 31%, and it's all going to be double. So 2/3 of India will be in middle class by 2047. So it's only going to expand that. And people have not only been saving, they have been investing now. So they are moving away from the lure of FDs, which are a losing proposition, into equity markets and associated products that it offers. So overall, we think that we are just getting started. India as a whole, as an Indian investors, we own about just 6-7% of Indian equities. Their portfolio is allocated only to that extent, versus markets like US, which are 40-50%. So we have a long way to go as India grows, the opportunities it provides. I think the investing in equities is just getting started. We will see big flows from Indian Bharat investor over next 2-3 decades that we will see. So overall, only thing is that we need to educate them and ensure that they end up with sensible asset allocations like the 12-20-80, and ensure that they don't just chase returns, but really build wealth over the long run that India offers.
All right, and these are great points, Chirag. Thank you very much for us to close our discussion. Chirag Mehta and Feroz Aziz, thank you so very much for being part of this discussion on the Economic Times.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.